This presentation, I would like to discuss how value investing provides long-term stability during market downturn. How value investing provides long-term stability during periods of market downturn. So I start with an introduction here. Number one, market downturn can be unsettling, but value investing offers a strategy that can produce or provide stability and protection during times of market volatility. Value investing focuses on buying stocks that are considered undervalued based on the companies and fundamentals, often leading to a more resilient investments in tough market conditions. Number two, so what is value investing? What exactly is value investing? Value investing involves selecting stocks that are trading below their intrinsic value, often identified through financial metrics such as a price to earning ratio, such as book value, and as well as dividend yield. Investors look for companies with strong fundamentals, consistent earnings, and a stable business model. But those stocks price, is lower than usually, the stock price should be lower than it should be based on the company's true value. That is, the stock should be trading below the company's intrinsic value. Number three, why value stocks are resilient in market downturn. Why value stocks are resilient in a market downturn. It has to do with lower valuation. Lower valuation. So value stocks tend to have lower price to earning ratios and may be undervalued due to market overreaction or maybe a temporary setback. So these stocks have less room for price decline compared to growth stocks. They're already undervalued, so they have less room to decline further down. And not only that, you discover that they are equally susceptible to correction. When the market corrects itself, you discover that value stocks will pick up, relative to stocks of other categories. They are, they are quite able to bounce back when the market recovers. And so this particular characteristics is very important, because investors stand to gain maximally when the market recognizes the inherent value of the company concerned. Not only that, there's just focus on fundamentals. Value stocks typically have a strong financial foundation, such as consistent cash flow, and not only that, it has low debt level, and it has a kind of established market position. In other words, the company involved is performing very well in this sector or in its industry. These characteristics can help companies weather economic challenges better than speculative high growth stocks. And not only that, we equally consider dividend yield. Many value stocks pay dividends, providing investors with a steady stream of income. There's that income stream coming on, particularly for income conscious investors. And not only that, it helps to cater for investors during market downturn or market volatility. This can be particularly appealing during downturns when capital gains may be harder to achieve. Generally, in the down market, capital gain through appreciation may be difficult to come by. But the fact that these stocks pay dividends, at least that would be enough to keep the investor going, pending when the stock will appreciate. There is defensive stocks or defensive sectors. Defensive sectors. Value stocks are often found in more defensive, sectors such as utilities, consumer staples, as well as healthcare. These industries tend to perform better during recession, since they provide essential goods and services, the kind of goods and services that that consumers cannot afford to do without. People would take care of their health. They would have to get utilities running in their homes, and these are services that that are in high demand even during periods of recession. Number 4, the role of margin of safety in value investing. The role of margin of safety in value investing. We want to talk about, margin of safety. What is margin of safety? And this concept, it was introduced by the legendary value investor Benjamin Graham, Warren Buffett's mentor. It refers to the difference between a stock's intrinsic value and its market value. The difference between a stock's intrinsic value and its market value. So a wide margin of safety reduces the risk of significant losses during downturn because the stock is already priced lower than its true value. And so the wider the margin of safety, the better. Let's take, for instance, a stock is selling for $10. If you can get that stock for as low as $5, you have a wide margin of safety. All right, as wide as of about $4, thereabout. And so the lower you buy, compared the lower you buy a stock, compared to its intrinsic value, the wider the margin of safety. So it equally provides downside protection. So investing in undervalued stocks with a large margin of safety provides that built-in protection, number 2, reducing the likelihood of steep losses during market decline. Even when the price declines from, let's say, $10, it might not decline below $5 at which you bought the stocks. And so the wider the margin of safety, the better for you. In terms of steep decline, you may not still lose money. And so when the stock price drops in a downturn, the chances of its reaching, reaching below the price you bought, is somewhat smaller. Is somewhat slim. So please like this video and subscribe to this channel if you've not done that. Number 5, behavior during downturn. Behavior during downturn. There's that less sensitivity to market sentiment. It has less sensitivity to market sentiment. Value stocks tend to be less driven by speculative trading, and short-term market sentiments, making them more stable in times of panic selling. Not only that, investors focus on the fundamentals. Investors focus on the fundamentals are less likely to react impulsively, to market swing or to noise in the markets, because you're more focused on the fundamentals. Definitely, you don't react to the noise around you in the markets. And that reduced volatility because value stocks are often less subject to rapid price swings based on investor hypes. They tend to exhibit lower volatility, so providing more stability during period of market stress. They are more stable during a typical market downturn. Number 6, long-term focus, long-term focus. Actually, when it comes to investing, patience, pays off. Patience pays off. So value investing, requires a long-term perspective, which can be beneficial during downturns. While the stock market may experience short-term volatility, the long-term focus of value investors help them, ride out market corrections and capitalize on the eventual market recovery. The market will not be down forever. Eventually, it is going to recover. And when it recovers, value investors, tend to gain, as a result of their patience. So equally consider historical performance. Historically, value investing has outperformed growth investing over the long term, particularly after periods of market downturns. When the market recovers, undervalued stocks often see a rebound that surpasses growth stocks due to their strong fundamentals. When the market rebounds, value stocks tends to rise higher, rebounds faster than a typical growth stocks. Number 7, how to implement value investing for stability. How do you actually implement value investing strategy? Number 1, here you look for strong fundamentals. You must consider the company's fundamentals. Focus on companies with a track record of stable earnings, low debt, and a positive cash flow. And not only that, these companies are better positioned to withstand economic downturn. And you may equally consider, buying when others are fearful. Generally, when others are fearful, they may, in a panic, they tend to sell their holdings. That is when you should buy. Someone say buy when there's blood in the street. And so value investing involves buying stocks when they are undervalued due to market pessimism or panic selling. Market downturns can provide opportunities to purchase quality stocks at a discount. Quality stock at a discount because the market discounted them, not based on fundamental, but based on sentiments. You also diversify your holdings. So diversification across industries and sectors can help mitigate risk by including a mix of value stocks, in defensive sectors. You increase the likelihood of your portfolio, gaining stability during market downturns.